So welcome back to the Kepler Trust Intelligence event focusing on the UK. Shortly we're going to hear from James Henderson, who is the manager of Henderson Opportunities Trust, who's going to talk to us about the fund and what it has to offer. As a reminder, if you haven't attended one of these events before, please put your questions in the box outside. We have roughly half an hour for the presentation and then roughly 15 minutes for Q&A. You will all be on mute, but if you put questions in the box, I will put those questions to James at the end. So James, over to you.
Thank you very much. Thank you very much, Thomas. It's always great fun to talk about Henderson Opportunities Trust. It is a privilege to run it. Usually a manager has a mandate that he has to keep to. Henderson Opportunities, you've got a blank sheet. You can go out to find opportunities in the UK market across the whole range of companies. And that actually isn't as easy always as it sounds. I often run income funds. I do run income funds. With an income fund, you have a discipline. When things are high yielding, you look at them. And when they become low yielding, you look to see whether that low yield is justified. If it's not, you sell them and you move towards the higher yielding stock again. And those disciplines are often good disciplines. In recent years, they haven't helped. The disparity between the high and low yielding shares has opened up. I believe the disciplines will reassert themselves and be good in time, but at the moment it is difficult. So with Henderson Opportunities, I don't have that restraint. I've watched various people run these mandates, and we've worked a way how to do it. I've watched how Henderson Opportunities itself was run from when it was launched back in the late 1980s. I was Richard Smith's assistant, and he was the first manager. And the style has developed. I think the way we've got it now with the bucket system, it really is the best way to do it. And I've run it for the last 15 years, to begin with Colin Hughes, and more recently with Laura Fole. It is a diverse list of stocks, and that's what I want to get across in this presentation. Diversity is all important. You'll get success from different parts of the market, and different things will go wrong at different times. But if you've got the diversity, you can grow the capital over time. It is diversity that preserves capital over time. And I like to think it's working. The 10-year return is strong because we've been able to move around and be in different parts of the market at different times. A lot of that return has been driven by smaller companies. We don't have to be with the big weighting to smaller companies, but that is where we're finding the opportunities. I don't think that managers need to be clever to produce good returns. What they need to do is they need to pay attention. They need to pay attention to market opportunities and always be on the listen for new ideas. They must challenge themselves about things that aren't working. Have they just got it wrong? Admit when they've got it wrong and move on. I find that perhaps the most difficult bit of the job. There are always things being thrown at you that could work, and it's often fun to be involved in the early stages of companies, but admitting when a company is no longer going forward as you imagine is the tough decision. But it's part of the diverse approach and the bucket approach that we have to admit when we're wrong and cut mistakes. But we mustn't be frightened of making mistakes. And during that 10 years that we're showing here, we've made plenty of mistakes. I've made plenty of mistakes. I had a holding in something called Conviviality, went bust. We had some exposure to areas of contracting that went wrong. But then again, we've had stock winners that have really pushed the NAV over time, and it's not symmetrical. The winners can more than make up for the mistakes. And you mustn't be frightened of making mistakes. You always will make mistakes. But we run relatively long lists of stocks. There are 90 holdings in this fund. And therefore, one mistake won't hurt at any one time. 2 or 3 won't hurt at any one time if we're getting also the other side, the good winners. I'm not blasé about mistakes, and you need to examine why you've made them. But if you're not making mistakes, you're not taking enough risk. I was watching Andrew Murray playing tennis last night. I thought about that. If he didn't occasionally serve double faults, he wasn't trying to hit his second serve hard enough. And that's as it is with fund management. You've got to be prepared to make mistakes, learn from them, and move on. That's the long-term return. We show sorry, I'm having trouble moving the slide forward. I'm just going to get some help to move the slide forward to the second slide. Apologize about this. Thanks. So this is single discrete year returns. You can see how lumpy they've been. That is part of equity returns and investing in the area. The investment trusts where the share price moves more up and down more violently than the actual asset value has meant that the share prices have been even more volatile than the NAV total return. But again, that is part of getting those long-term returns, that there is occasionally you are out of favour, and that's often the time there are real opportunities. But how does our bucket approach work? We have a range for different sorts of things we're looking at. We use different valuation metrics for these different buckets. So I'll start at the top there. Special sits. Special sits, we're looking across the market for things that are, because we're in a big house, we see things that are just the wrong price for a technical reason. The example we give there is Red Centric. It had an accounting problem. The shares fell a long way, but the actual business was okay. So we could take some shares because people were so worried about the accounting problem, and that they've recovered nicely. The other day I took some placing in a company that I thought was relatively expensive, but I could see that the enthusiasm for it, and I sort of stagged the issue. It went up 25% on the opening, and I sold. Actually, it's gone up another 20% now, but I'm not worried about that. There was an opportunity to make some short-term money, and we took it. That's only a little bit, but if you are working in a big investment house, you do see these things occasionally, and you just need, in a disciplined way, to be able to add value. But it's not a central strategy. It's just one of the small buckets, and I wouldn't have more than 10% in that bucket. Then there is the growth small cap. And the example we're giving there is Blue Prism. These are the exciting companies of tomorrow, and some of them won't be the companies of tomorrow. They will fail, but the ones that succeed will become substantially bigger businesses. I will go into further examples later. And then to bring ballast to the portfolio, and because we are looking at big companies, me and Laura, the whole time, we're running Lord Venture, for instance, which is predominantly in larger companies. So we see opportunities there, and we need to take them. Or we keep it to 10 to 30% of the portfolio, this ballast. I often think the gearing the portfolio is, and this part of the portfolio have got to be matched. So, or or we've got to more than cover the gearing from this part of the portfolio. At the moment, we're about 12% geared. We've got a bit more than that in large cap growth. That is because the valuations in large cap, in the stocks we're holding, I think is very reasonable. A bit of one of the buckets I enjoy running is the recovery bucket. In there at the moment, there were plenty of opportunities to really refresh and build that bucket last year. One of the examples I give here is Vertu Motors. A year ago, who was going to buy a car? And anyway, weren't they going to be disrupted by the new models, the new platforms that were coming along? Actually, they got completely oversold. It's a company with a really good management team. They do come out the other side, as does the share price. As I say, it's always about diversity, and the natural resource bucket sometimes performs very differently usually to the rest of the portfolio. Sometimes it has been the strongest area. It was during some of the Brexit problems. The UK economy was being stressed. Investors weren't wanting to look at the UK, yet obviously the overseas natural resource companies weren't part of that. And there's some good returns made then, when actually the UK economically sensitive businesses were poor performers. An area that we spend a lot of time thinking about are the spin-outs. People will say the UK, there's lack of technology. It's just not true. There's just lack of big tech sometimes. It's often been sold too early to overseas investors, overseas companies. But actually, early stage tech, there is a lot going on. The universities spin-outs are some very exciting companies. Some of the real tech companies of the future will come from there. Oxford is producing some of the most exciting. We've got an investment in Oxford Science Innovation. It's the only unquoted in Henderson Opportunities Trust, but it is the spin-outs particularly from the chemistry department at Oxford, and they are one or two are coming through very well. They were the company that's producing with Astra the jab that is working against keeping COVID, muting the COVID problem, comes from one of those companies. But also in computing, there are some very exciting companies on artificial intelligence coming out of Oxford at the moment. There is no lack of real good science. It is taking the science to the next level. And with the team at OSI, that may be happening. They're mentoring companies, they're growing companies. It is exciting, and it's also good for us to learn about them at that stage, because they will be part of the portfolio going forward. And the last bucket to talk about is perhaps the biggest bucket always in the portfolio, and that's the small cap compounders. These are companies that have really good management teams, that they come from across the economic spectrum. They are large, they're medium-sized companies and small companies that will grow into large companies over time. They will do it by incrementally growing year after year. And an example I've given this morning, I'm quite glad I put this one on the slide. Springfield, they did a very good trading statement this morning. You might think, why is a Scottish house builder a compounder? Well, it's just a very, very large land bank that it's slowly building out. The management really does add value to what it does. It is a real long-term story of developing the value that's there. And that part of the portfolio is the core, really. More that we can have successful long-term compounding stories, the companies that go from small, medium, and then towards large. That is the core of what we're looking for, and will be part of the driver of the portfolio going forward. So just some examples from each bucket. I realise I'm talking stocks a lot, but then this is about stock picking this portfolio. And I'll come to economics later, but really our focus is on companies. I was told early on when I managed money that investment was about three things. It was about management, management, and management. And I do sort of believe that really good management teams can be found in many different activities. It is realizing that management team is taking its eye off the ball. That management team shelf life has moved on. That is important. But the early days, it's about the drive and the enthusiasm. These two companies, Blue Prism and Boku, have got that. They've got really teams that have got great enthusiasm. Blue Prism, we invested when it first came to the market. It was a major contributor to performance in 2016, 2017, 2018, and we did reduce. With hindsight, people would say we didn't reduce. We should have sold the lot. We didn't, because actually I believe it's in the story in the medium term. There are people have worries about the company, and certainly in the States, the companies in the area are substantially better funded, but the growth is still coming through at Blue Prism, and the valuation is now low. And I'm looking at it actually to buy back stock or add it to another fund at the moment. It is the technology works. Customers they have are using more of their bots going forward than they did in the past. Boku is about payments, the payment system. It's again wonderful to see a UK company expanding and growing across the globe like Boku is at the moment. It's still a small company growing fast. It's about paying attention to these companies. You can see from both these charts this huge volatility in the share price. Both have had stable management teams over this period. Both have produced results over this period. But the share price has been volatile, and it's been difficult to sometimes understand why it's been so volatile. What do we do about it? Well, into real strength, we will reduce a little bit, and into weakness, we will buy back a bit, just to try and smooth that. We'll always probably be buying too early, and we'll usually be selling too early, but that's always a better way than doing it too late, and we're doing it in relatively small size. So that's the small cap growth. It is volatile. There are some very exciting businesses for the medium term there. This is small cap compounders. RWS has been in the portfolio a very long time. Colin Hughes originally bought it. It keeps producing the results. It keeps incrementally growing and occasionally making very good acquisitions. It will occasionally look expensive, and we may just sell a little when it looks expensive. We probably get a chance to buy it back sometime, but it remains a core part of the portfolio, long-term core holding, because it's still on that very strong growth trajectory. I've talked about Springfield. This again is coming through with the results, but look at this volatility. 160 to 60, actually they're going fine through it. Suddenly this recovery. Don't overly worry about the share price movements in the short term. Is the company producing the goods? And this company is building out its land bank successfully. We try and use the weakness to add, as I say, but that's not really the skill. That adds hopefully a little bit of value. What really adds value over time is being in companies that will come through with that strong growth, well-managed businesses. And large cap growth. Spent a lot of time following both of these companies over the time. We need to take advantage of that. and when they are cheap, to add a few. And I think they both their way are cheap. I think the Pru is now more fully valued than it was, and it could be on our list to reduce. Whilst Aviva, there is real change happened at Aviva. People say, oh, these big insurance companies, big legacy businesses going nowhere, but there's real change happened. They've got out of areas there they didn't have real advantage in. They've moved and they've kept with the areas that they do have competitive advantage in. The management changes at Aviva are really positive, and it's really good to see a large company that has been a relatively problematic for many years beginning to emerge and move forward. And then the resources. The resources, as I say, are a fundamental part of the mix of the portfolio. I put these two in. Serica, in a difficult year for us in 2016-17, leaving the ERM, UK economy under pressure. We got more in the UK economy and UK earnings than the index and much of the competition. So difficult when the UK was slowing. Serica was a very strong performer that year. North Sea gas wasn't affected by the UK economy as such. It was their own skill buying assets off the major at the right price, developing those assets that led to the share price strength. I'd say that one of the areas of real interest to me, of real undervaluation in the market at the moment, is North Sea oil assets. The big companies have been selling down. ESG concerns mean many investors have been selling down. And that's creating the opportunity. Whilst Rio is a wonderful mixer to the overall portfolio, as I say, we're quite UK orientated. To have the big international commodity company Rio there brings that diversity. And two companies we spend a lot of time looking at, early stage companies. We're invested at 4D at the start, sold a bit on the way up. Should have, when you look at this chart, sold a lot. Actually, I think the science is robust. It always takes longer to come through than you think at the time, or the management think at the time. We need to look at it again, whether we should be adding. It's because of the fall and having sold stock back in 15-16. It's a small holding, but just because it's small, we've got to pay attention. There'll be the right time to buy it, as long as the science stays robust. Ceres was the biggest contributor to the performance last year, and actually in the last 6 months it's been the biggest detractor. But actually overall it's added real substantial value. One of the areas, little pockets of stocks in the portfolio that added a lot last year were the alternative energy shares, and this one in particular added real value. As it became relatively more expensive, we did keep the bucket size, don't let it grow over the 20%, but that bucket of those early stage companies did go through 20%. We did reduce it back down to below 20%. And we sold some Ceres. Actually, over the medium term, I still think it's absolutely right. The company's developing really well. I think in 10 years' time, we'll think, oh, why did we sell any stock back in 2020? Well, we did because as a percentage of the portfolio, it became too big. There are periods when these stocks are relatively out of favor. Sorry. And two recovery specialists. As I say, I really enjoy the recovery area of the market when no one wants something and you can see that it's still a decent business under all the noise. That's when you can really make money in shares in a relatively short time. IPF, I'm particular example of that. You know, unsecured lending this time last year in Poland, Mexico, and places didn't sound like a recipe for success, and investors sold it down very hard. Actually, it is a well-disciplined, good team. Yes, sometimes the wind is in their face, sometimes the regulator is hammering at the door, causing trouble, but it is that team that's sound and providing a service to people that really need the service to people that aren't in the banking system. They still need to borrow money sometimes, and the success of the company holding together in that difficult period and coming out the other side and growing again, seeing the share price move up, it still remains moderately cheap. So new buys, we've been adding some, making Barclays a bigger holding, recovery happening in the banking sector. I think they're not just branches of the civil service. They are companies that control their own destiny to a certain extent. And if rates go up, they'll have wind behind them. Jubilee Mining was looking for opportunities in the mining sector, real diversifier, recovery happening, really ambition in the management team at STV is a change from the past. There's real wanting growth. It's coming through, very exciting. And actually Kia has been the largest purchase of late. The UK economy, and perhaps I will just conclude by talking about the UK economy, is recovering. And that recovery is going to surprise people. We've got, and infrastructure spend is happening, and Kia is positioned to benefit from that. HS2, there's work on that. That is absorbing capacity. It means people are now tendering for contracts at the right price. This is the overall portfolio. This does look strange when you see Barclays now the biggest holding. That's been buying of late to make it the biggest holding. We think that they're well provided on their book. They will get returns on equity that justify significantly higher price. And the next one down, Springfield Property. As I say, it had a good trading update today. It's a real long-term growth story, building houses in Scotland. It looks quite strange to have these mix. And further down, you see Ilika, the solid-state battery company, could be a huge growth story if they succeed in their ambition. You know, but it's almost pre-revenue at this moment. Then a bit further down, you've got NatWest. It looks strange, but it is this diversity. Each company on the list, I believe, will grow. It's got a management team that will move it forward. And looking down the list, you've got Next 15, advertising, really strong management team growing that business. And then Serica, North Sea, big mix. And I just conclude with a little bit of a view on the UK economy and why being UK focused is desirable at the moment. There are real good diversity you can find. You can find good companies in very different industries, and we're running with our 90 stocks a diverse list of these companies. Quite a lot of them can be found on AIM at the moment. So 54% of the portfolio is on AIM. We don't have to be on AIM. We will reduce it if we don't see if there's better value elsewhere. But from the tech shares, blue prisms, they're so cheap in comparison to the American equivalents. So the tech's cheap. The industrially cyclical shares are cheap as the UK economy recovers. And the consumer stocks were seriously oversold at times last year. We're seeing recovery there too on the high street. These are exciting times with plenty of opportunity. Please, anyone got any questions? I really enjoy answering them. So I feel very enthusiastic and enjoy very much talking about HOT.
Thanks very much, James. We do have a few questions already. We've got roughly 15 minutes, so please do put your questions in the box. We'll try to get through all of them. So someone has asked, 90 stocks clearly is quite a large portfolio, and a lot of them are small caps. How do you deal with keeping on top of so many companies? So you have your co-manager, Laura. What other resources do you have, and how do you keep track of so many companies at one time?
I think one of the things about working in a big office is you get to know who you think really adds value. And for instance, in resources, we've got a really good resource team at Henderson's at the moment. And I'm not on top of RTZ, but they are. And I go to them for RTZ. We've got a very good team in property as well. So I listen to them. There are other teams that I smile and talk to sometimes, pay absolutely no attention to what they say. But no, the property and the resource team are really good. So they do that. As you say, Laura and me are working together. I find it a real good discipline to look at small companies because it's about the business. You know, it's not about market sentiment. It's about the business. So that focuses you and grounds you in what's happening in the economy. People say, what, 90 stocks is a lot, but when you just showed you those slides of volatility of businesses, you know, look at these, look at that slide of early stage companies. They are up and down. If you put 0.3 in Ceres was 8.5p when I bought some, and I put 0.3 in. Well, it's now, you know, over 10, it's 10 quid or something. You know, it doesn't matter that you only put 0.3, and I had still had to reduce it because it's too big a part of the portfolio in time. And when you're there pre-revenue, you wouldn't want to put more than 0.3 in to start with. That's same with recovery stocks. Some company recovery stocks won't recover, but the ones that do will recover substantially more than the ones that don't, because the ones that don't can only fall to zero. You know, from 0.3 to zero. If you got 10 times from 0.3, you know, it finances quite a few of them, one or two of the mistakes. So that's why we need long stocks, long lists. I think actually, in a funny way, long lists make you bolder. We're buying quite often, particularly in the recovery area, before there are ticks in every box. There are real question marks about something. That's why it's fallen a long way. But we believe that those questions will be answered. By the time they're all answered, the share price can be substantially higher. So we don't have a tick list of things a company has to be before it comes onto the portfolio. We try and move earlier and take advantage of having the privilege of having this closed-end structure, knowing we've got our capital to be able to buy the recovery situations, knowing that we're going to have time to see it through. And this time last year was a wonderful time to be buying stocks for a closed-end fund, putting on a bit of gearing, and by knowing that you weren't having the money taken off you, and things had been sold down too far. In, for instance, IPF, that one I showed. But you wouldn't want it to. There were real uncertainties. You wouldn't have wanted to make it a large holding. I couldn't run short lists because we are buying when there's still a lot of noise around the company. You know, a lot of concerns out there, and therefore, long list is very important to me. Are there any other questions?
Apologies, I was on mute. Could you speak a little bit about the difference between Lowland and Henderson? Is it purely market cap?
No, Lowland is a third large, third medium, and third small usually. It is, and the recovery element is there with Lowland. But what is less there is the early stage companies. I do have some exposure to early stage companies, and then it's very small. They won't pay a dividend for the next 10 years. These companies, so it's difficult to have too much in an income fund of that sort of thing. Whilst yes, with Henderson Opportunities, we grow the dividend every year, but it's from a low base. So quite a lot of the portfolio won't be yielding. Obviously, we brought the banks in and things, and they will provide income and will help that dividend growth for HOT, but it's from a much lower base than with Lowland. Lowland has got much more in cheaper shares, but they will grow less fast than the stocks in Henderson Opportunities. It's got less in AIM, but it's got a good percentage in AIM, Lowland, but it's got less in AIM, and it's got more in the FTSE. But a lot of the themes are the same. It's just that there isn't the element of there is less in zero yielding shares, and less in AIM.
I think I have a question about the discount. So it's at 13% now. It's obviously been very volatile over the last year in particular. So the question is asking why you think the discount is so wide at the moment, but also, do you think the small size affects the type of investors that you can attract?
Yes, definitely. The small size puts off the big institutional or the bigger wealth managers. We've got to make the small size count. I could get out of these small AIM stocks because it's 120 million market cap. HOT. We can really utilize the small size. We can buy companies, very small micro companies that are not being followed properly. It's so much easier to buy a company that isn't and make money out of it when you're one of the few people paying any attention to it. There are lots of clever people out there looking at the big companies. It's much more difficult to spot the misvaluation amongst the smaller companies not being followed, where people are not, where they're disinterested, and you only have to, you can get there by paying attention and making, and those smaller companies do help those really small companies. And we will buy 10 million market cap type companies when it's really outstanding opportunity down there. Why is there a discount? Well, because we don't have, it is too small for those big houses. It is for the private individual and the smaller fund managers, where it could be a real differentiator to their portfolio. It will, and the swings and discounts, nothing I don't worry about it. I know people, I know I'm meant to, but I don't. I just think about growing the NAV, and the discount would sort itself out. I think a month ago it was a 2 discount. It's now at a double-digit discount. Why? I don't know. I don't know. Just they move around, and I'm not going to worry about it. What I'm going to do is work at growing the NAV, pay attention to companies, follow companies, look for opportunities, and then the rest sorts itself out. I've got I run Lord Adventure that's on a small premium, I think. Lowland, which is on a 5 discount, and HOT that's on a 10 discount. Why? I don't know. I don't know. It's for other people to decide that. It's for me to tell the story as I see it and to try and grow the NAV. I don't like discount control mechanisms, because this time last year, if I'd had a discount control mechanism, we wouldn't have had any confidence in going out to buy small cap, and that's where the real value was, because we wouldn't be sure if we weren't going to have the money grabbed off us by people wanting to leave. Because it's closed-ended, you had the confidence to go out and buy, and that's a real privilege, and we've got to make it count. But the other side of that is there will be this volatility and premium discount.
So we had a question around Glaxo. So it appeared in one of the earlier slides, but it's not a top 10 holding. What bucket does that fall into? Do you regard it as a special situation, or is it a long-term growth stock?
I think the valuation is undemanding for what it is. I think they are addressing some of the worries in the past, and they only need 1 or 2 drugs to come through that pipeline to for people to look at the company very differently. It wasn't many years ago that people despaired of Astra's drug pipeline, and now everyone, the analysts, really like it. That was, we were told there was nothing there and it was going to take years for everything to come through. But within 5 years, they were saying completely the opposite. I think that can happen to Glaxo as it's happened to Astra. These companies do need a bit of luck with their drugs that are in phase 2, phase 3 trials coming through successfully. But there are some there that we think will come through. You're talking about how we run these long lists. I honestly don't go to any Glaxo meetings. Laura goes to all the Glaxo meetings. I think I spare her some of the financials and one or two of the industrials, but we go like that. And so Laura would have given you a more articulate answer to that question than me.
You mentioned it being very difficult to cut mistakes or to recognise when you've made a mistake. A member of the audience is asking, why is that difficult? And are there any good examples of where you successfully recognised a mistake early, if you like, cut a company that failed to deliver, and where you failed, where you didn't cut a company that you should have?
Yeah, certainly a lot of the latter over the years. You make excuses for the company, you make excuses for yourself for why you're getting it wrong, and you're always hoping that that things will get better. So it is always a difficult one. We don't ever have a stop loss. So if something a share price does fall, we re-examine and need to ask ourselves, are we wrong about the company? But then if we think actually, look at the volatility of some of these shares we've shown, if actually it's more price movement than reality, we will add rather than on a price fall, rather than say, look, we're wrong. But occasionally companies do lose their market place in their market. I mean, the life cycle of companies, I believe, is getting shorter because the speed of change is greater that's going on there, and you can be and the world moves on, and sometimes companies don't. You always hope that a company will rediscover the formula or reinvent itself in some ways, but sometimes they don't. I could go for a whole list of companies that as I said, I've run Lowland since 1990. I've run this fund for the last 15 years. I've run Lord Venture for longer. I mean, there are plenty that gone wrong, but just as I say, some have reinvented themselves, and some of the best buys have been companies that were once stars and had fallen out of favour, only to reinvent themselves with new management. So I do beat myself up at the time about holding companies too long that go wrong, but then it's important to move on and look on for new opportunities. In the current climate, with the growth coming through in the UK economy, actually some of the things that you think are a mistake will be the area of the portfolio that will surprise you and give you some of the best returns. So I'd be careful about selling underperforming companies at the moment, as long as the management is really focusing again on the business, that there'll be good returns made.
We had a question sort of asking about the opposite problem. So when a company does a lot better than you expect, how do you know when to sell? I suppose you showed a few examples where there's been remarkable pops in the share price and then some very, very quick drawbacks. How do you know when a company has moved too much? Do you have price targets, or you have some other way of assessing it?
No price targets either, and I don't know when to sell. The market always, things are rarely as good as you're told, and they're rarely as bad as you're told. And stock markets get over enthused and then get then overdo the disappointment. There is no correct way of doing it. All we do, I don't sell. We don't walk in one day, me and Laura, and say, let's sell the whole holding. What we'll do is gradually reduce, sell small amounts. So say something like Ceres, I actually sold stock at £5.50. Went on to sell some more at twice that price a few months later. No, I don't know. It actually, we just slowly reduce, booking some of the profit, keeping with the disciplines of not letting any of those buckets get out of those ranges by much. You can do a little bit, but we'll be bringing it back into the range. So that something like Ceres was sold to keep it within the range. So don't get greedy, don't get too greedy, but you'll often be surprised by how far the markets take their enthusiasms. And don't worry if you've given up some, if you've sold too early. You're never going to time these things right. 10% off the top of the holding, 10% off the top of the holding. And you get an opportunity again, as I keep looking down at some of the slides I've got on the pack.
And we've got time for just the one final question. So, and it's quite a nice question to conclude on, I think. So, looking back over your career, how does this current moment compare in terms of the prospects for UK growth in the UK stock market? How does that compare to what you've seen in the last 2 or 3 decades?
I'm glad you said 2 or 3 rather than 4 or 5, Thomas. Thank you. I've never known UK investors to have less in the UK, which is a lovely starting point. I saw a big UK fund of funds the other day, and he told me at 5% he thought he was 1% more in the UK than this other very large fund of funds. That's an extraordinary position to be, to have for UK savers to have so little in the UK market. Yet the UK market is going. The UK economy is growing. And actually managements are the best managements. There's a big generalization, but there's more ability at the top of companies than I've seen before. That's partly to do with the diversity that's come through in recent years. There's some really able young management teams driving companies. So I think it is exciting times. But as I say, the speed of change is greater, so the life cycle of companies has got shorter. So you have to be careful. Nothing is lasting forever. Nothing works for as long as you think it's forever. The change is happening, so you have to be careful about that. But the actual base position that we're going to get some of those people, some of those fund of fund people that are down at 5%, 4% in the UK, they're going to be back at 10 or 11%. At some time, we're going to get their money off them. We've heard from other speakers about international buyers. There will be international buyers. The shrewd ones are buying stock too cheap, I think. But that's inevitable at this stage of the cycle. So with quite a lot of excitement, I'm looking at companies at the moment. It's a nice position. Modest, all right valuations. Top line growth coming through, which will surprise, operating margins expanding, at the same time as there's a lot of cash that we can possibly get from UK investors to help fuel the needed capital spend of UK companies. The UK stock market has worked last year. There were rescue rights issues for companies to refinance, and for those refinancing to lead to profitable growth going forward and substantially better businesses. So no, I'm really excited, Thomas.
Fantastic. Well, thank you very much, James, for talking to us. We need to draw to a close to leave some time for the next speaker, which will be James Dupper of Edinburgh Investment Trust. And thank you for your questions in the audience, and please stay on for that. James, thank you once more. Really good to hear from you, and thanks very much.
Always enjoy talking about it. Thanks, Thomas. Thank you.
Bye-bye.
Bye.